There are extremely easy ways of earning excellent low-risk returns on capital through learning the details of a simple option strategy. I'm Seth Freiberger, the head trader of SMB Capital's options trading desk here in Manhattan, and we have traders and investors from all over the world reaching out to us for advice on how to use options to reach their trading objectives. So if you're interested in an easy-to-learn strategy that can substantially increase your investment income, then stick around because I think you're going to find this useful. Hi, I'm Seth Freiberger, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Newer traders and investors may not fully realize what unprecedented times we're in, but here's a very long-term chart going back more than 50 years of the 10-year Treasury yield, which most of you realize are United States Treasury debt obligations, widely regarded as the safest investment in the world and a benchmark for other interest-bearing instruments that have more risk. This situation has been created by an extremely accommodative Federal Reserve Board, which is trying to lift the economy out of this pandemic-related recession by lowering borrowing costs. As a result, the yields on bonds and other debt instruments have also plummeted to the point that investors simply have no motivation to invest in bonds if they're looking for yield. The result has been that dividends paid by common stocks, otherwise known as equities, are seen as the only alternative for income in an environment of near zero interest rates. But there's another way to earn yield that is not directly derived from equity shares, and that involves trading options. Now, in order to explain this strategy, I need to just quickly make sure that everyone who is watching this video understands how equity options work. And I realize that most of you probably know something about how options work, but just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at the strike price. In other words, he's entitled to buy the shares way below the market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless, and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless, and the put seller just pockets the premium. Okay, so now with that as background, let's take a look at the shares of H&R Block, the tax preparer trading with the ticker symbol HRB. And as you can see, in early 2020, the shares were trading at $24, then dropped precipitously to down below $12 until bouncing with the rest of the market. Over the summer, the stock tested the 13 area a few times and seemed to find support in that 13 to 16 area before rallying again. And on January 8th, the stock had closed at $15.91. Now, HRB stock pays a dividend of $1.04, so that would be a yield of 6.5%. If you do the math, that's an excellent yield for a stock and enviable compared to over 90% of all dividend yielding stocks. So if you were looking for yield, this wouldn't be a bad place to find it. But there's actually a far more attractive approach to squeezing yield out of HRB shares, and that is through the use of options. Now, before we get into how you can use options to more than double the yield of HRB stock, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable, long-term techniques for trading options for income. In that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. In this webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open a free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. All right, so back to the HRB trade. Let's go back now to January 8th when HRB was trading at $15.91. And as you can see, if we go out slightly over a year to January 21st, you'll see that the puts located at the 15 strike price, just a little bit below the market price, are selling for $2.60. So if we sell 10 of those, let's talk about the cash flow implications of this trade. And as you can see, if you remember, we take the $2.60 price and we multiply that by 100 because each put represents 100 shares of stock. And we sold 10 of those, so that total cash flow from selling those puts is $2,600. Now, of course, if HRB drops below 15 at any time between now and January 21st of next year, then there is the possibility that the owner of those 10 puts could exercise those puts and require you to buy the shares at $15. So you need to set aside $15,000 for that, because if the trader exercised all 10 puts, you'd have to buy 1,000 shares at $15 per share, as you can see from the calculation, because each put represents 100 shares and you own 10 of them. So you really need to consider $15,000 as your capital requirement for this trade, as you can understand. So let's consider the different outcomes of this trade. The first outcome is pretty excellent on its own, and that is what happens if the shares never get assigned at all, because HRB closes above 15 on the day the options expired, and the guy you sold the puts to, while the puts were alive, just didn't have any motivation to sell his shares of HRB for $15, which is most likely because the stock never dropped far enough to make him have a desire to sell the shares at 15 at any point while those options were still alive. Well, in that case, you would just pocket the $2,600, giving you that 17% plus return, as you can see. So that is nearly triple the return on owning the shares. And if you're looking for return, 17% is pretty damn good in a 1% or lower interest rate environment. Now, let's look at case 2. And in this case, for whatever reason, probably because the shares dropped below 15, you, as the seller of the 10 puts, get assigned the shares and have to pay out $15,000 to buy them. So now in this case, it's actually really interesting, because remember, that $2,600 you received initially, which would constitute a 17% return, that is yours. You get to keep that no matter what. Plus, if you're assigned the shares, you receive that $1.04 per share over a year, which is a 7% return annually. And so after owning the shares for a year, you'll have a return of more than 24%. And then thereafter, assuming the dividend isn't cut, you'd earn close to 7%, which is far better than any fixed income bond investment. Now, this is not to say there are no risks in this strategy. So you need to have a plan whenever making a trade like this. For example, you could be assigned the shares and then the stock could drop below the bottom of that support range, below that 13 level. Well, in that case, your plan could be to close the trade if that 13 support doesn't hold. Well, in that case, we'll start by recalling that we originally received $2,600 for selling those 10 short puts. But then after they were signed, you'll all remember we paid $15,000 for the 1,000 shares as we discussed before, and because you're hitting out of the trade, you'd be selling them for $13 per share. So the proceeds of the sale would be $13,000. Thus, your loss on the shares would be $2,000, but that would still result in a $600 profit on the trade. In fact, as you can see from the break-even analysis, you could even drop the ball on selling your shares down to a $12.40 price and still at least break even on the trade. Not that you'd want that to happen, but it's a cushion of safety. And of course, if the shares get assigned and HRB bounces, well, that's all gravy. Then you not only get the 17% return from selling the puts and the nearly 7% return each year from the dividend, but you get the capital appreciation from the shares as well, which would be the best case scenario, of course, on the trade, and you'd need to decide when you want to exit on the upside. So what I'd like you to take away from today's video is that if you're resourceful and can think out of the box a little bit, you can make a great deal of additional income from dividend-paying stocks than you might have originally thought, because selling puts well into the future is such a powerful way to capture additional income from stocks that you otherwise would have simply bought for dividend income, not realizing the exponentially large additional income potential that lies in selling puts, particularly puts at strike prices where the purchase of the stock gives you that additional potential appreciation from the stock price itself because your entry price was so great. On top of that, as we showed you, the short put creates a safety feature as a result of the put premium that you receive, so that even if you're assigned the shares by the put owner and the stock goes down, you have plenty of room to still make money or even at least break even before the trade really becomes problematic. So in high dividend paying stocks, entering them through selling short puts is a great way to get more potential income out of the trade at a great price and a built-in bonus margin of safety on the trade if it goes against you, so that you can still make a profit well below your entry price if you utilize the technique that we taught you in this video. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so that you won't miss all the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader. Why don't you comment below mentioning stocks that you follow with high dividends, and perhaps we can do a video in the future with one of the examples that you bring to the table of this short put strategy to create income.